Right, so it's Thursday. Yesterday, we just saw one of the worst market possible. Um, but yeah, you thought that the market was bad yesterday in the morning. Then when the Fed's minute actually dropped, then you know what's up. So yeah, anyway, let's cover some news today. But instead of me covering three news today, I feel that it's better for me to actually just cover one news because this is so huge. So basically, over at Bloomberg, it says Fed leaves a gradualism behind with urgency on rates. Basically saying that the Federal Reserve want to increase their rates exponentially quicker and harder. So basically, let's look over at the minutes that I actually was studying through yesterday. Okay, so over here you can see that it says the committee commenced normalization by raising the target range for the federal funds rate and then reducing the Federal Reserve assets holding in a gradual and predictable manner, as well as the timing for these steps. So for this part, basically, we actually had a teaser moment for this. We had it on Tuesday, I believe, where we have a market crash because the Feds basically said that all right, we are basically stopping to buy a lot of market assets, which is why we had a crash on Tuesday. So when that actually happened, basically, we didn't expect these minutes to actually come out, but since these minutes actually came out, and then we now know what actually happened, it kind of was foreshadowing for what is going to be happening yesterday. So yeah, over here, basically they're saying that okay, we are gonna be reducing our assets holding in a gradual and predictable manner. Not so predictable because no one was expecting such a bad FOMC meeting minutes. But anyway, over here, then afterwards, they did say that, the participants judged that the Federal Reserve to be better positioned for normalization than in the past, which basically they are just saying that, okay, you know what, the economy, basically, we are ready to have a faster taper. We are ready to have a faster rate hike. We are ready for more rate hikes, basically. And for the participants in this case, it simply means the FOMC members. And yeah, they just means that they basically just want to say that okay, like the economy is ready, like we are ready to go harder on the economy, kind of thing. So participants generally emphasize that in the previous normalization episode, as expressed in the committee's statement on longer run goals and monetary policy strategy. This was from the in regards from the previous FOMC in November. All right, so over here they said they noted the current conditions included a stronger economic outlook, higher inflation, and a larger balance sheet. Thus, could warrant a potentially faster pace of policy rate normalization. So over here, what they basically mean is that because when we actually see inflation happening, we usually means that with a high inflation, it means that the taper would eventually have to come. That's how you actually lower the taper. And because of this, what they're trying to say is that, okay, in November, we had a 6.8% inflation year over year. And because of that, we kind of have to strongly taper back. And because of that, they say that, this could warrant a potentially faster pace of policy rate normalization. Means that they kind of want to faster finish the taper and then they can faster raise the rates, which is horrible because the things that we were expecting the first rate hike to come in May. But this, if the taper were to end by the first week of March, we might actually see the rate increase in the second week of March, because that's when the FOMC meeting actually happens. If I'm not mistaken, it should be the 15th of March. So when that happens, there could be a very, very high possibility that we will see the rate hike immediately happen in March. That's basically what's happening in this entire meeting minutes. The most base case kind of point of view. So a few of these participants raised concern that a relatively flat yield curve could adversely affect interest and margins for some financial intermediaries, which may raise financial stability risk. So over here, what they mean is basically saying that, because of the current flat yield curve, because of how inflation is, the yield curve will always be flat. And because they want to also take money out of the markets, basically this is just further flattening the yield curve. And because of this, when they said that this might raise a financial stability risk, basically financial stability risk is closer to recession. You can basically just call it a market recession. the bear of all markets and such. Okay, over here they say inflation readings remain high. The various indicators suggested that inflationary pressures have broadened in recent months. So this is basically they are so-called working for them to say that, okay, because inflation is so high now, we can basically just go on with the tapering and also the rate hike. Okay, so over here, they did say that, okay, in November, 6.8, like I said before, the core CPI. Okay, the real PCE growth appeared to be picking up in the fourth quarter despite an upturn in COVID-19 cases. So over here, I did make, so usually when we have COVID happening, that's when inflation actually goes down, because when COVID is happening, most of the time people tend to not spend as much money, and because people tend to not spend as much money, the whole supply and demand go down drastically, and then that's how inflation kind of like dwindle away, which is why in 2020 our inflation was like 0% basically. Right, and then there's when you have stimulus waning as well, because over here they did say the waning effect of the previous fiscal stimulus measures, lingering supply bottlenecks, and recent increase in the consumer prices. So basically, this is just saying that, with the stimulus going away and with COVID still around, that means that inflation should be going down. However, inflation is still going up. So of course, I think on the 13th of January is when we actually see our core our CPI, which is our consumer price index. So that's when we actually see the December index to see if we actually do see a very, very high inflation. If we do get our year over year ending at 7.2% or something ridiculous, right? Then yeah, I think that will basically ring the bell to like tell the Feds, be like, okay, you know what, we're all good to taper faster. We can finish by March. We can definitely raise the rates by March, and then we can continue. And there is a high possibility that we can raise rates 4 times. And that's the scary part, because the thing is that I actually talk about this in my market is crashing video. I think somewhere you can just check. I'll just link it somewhere up on the corner. Okay, I basically said something along the line that that some of the committee member did say that they are looking at 4 increased rate hikes, and I'm not very sure that would happen. But this is now starting to look like a very, very possible happening. Okay, so over here they say, persistent bottleneck in supply and transportation were reflected in the record high inputs and output price components for the purchasing managers index. So this is the PMI that they are talking about. So the PMI basically were going down, and because of what we're thinking is that because when Jay Powell was talking about the whole inflation being transitory, now we cannot say that inflation is transitory, because the one factor that we did not take into account, which is the bottleneck in supply and transportation, is now going to be over here persistent. Okay, when they say persistent, usually when the Feds use the word persistent, it means we are going to be here for a year or two. Okay, so over the intermittent period, a rising inflation and FOMC communication appear to have put a substantial upward pressure on the shorter date treasury yields, basically the 2-year treasury yield. I would say that only the 2-year, the 5-year wouldn't really have that much pressure on that. But yeah, I think only the 2-year would most likely be the one that is under pressure. All right, so suggested that they have pulled forward expected rate increases more into 2022 and 2023 compared with the timing they anticipated at the time of the previous FOMC meeting. This is horrible, because the thing is that means whatever dot plot that we actually had before, there's a high chance in January, the next FOMC meeting, the next dot plot that we do see, right? There's a high chance that we might actually see 4 rate increases, and for 2023, we might also see 3 to 4 rate increases as compared to the 2 rate increases that we were expecting for 2023. So that's actually quite crazy. So the potential for a less accommodative policy stance over the next few years contributed to a notable rise in a 2 and 5-year treasury yield. So basically what I said before, more pressure on the 2-year and most likely 5-year as well. But I don't think the 5-year is going to have that much pressure. All right, so on net, inflation compensation has declined moderately. Inflation outlook appeared to be outweighed by the increase in the perceived prospect for the tighter monetary policy, basically talking about taper. The credit quality remains solid. This is actually quite good, because the thing is that basically credit quality just subprime loan. Remain solid and strong earnings growth. S&P 500 firms earnings report for the third quarter again exceeded analyst expectation. Trailing default rates on corporate bonds and leveraged loans declined to close to historical lows in October and November. So basically, they're just talking about how the rates for bonds are actually going down to its all-time low, which basically means that people are actually getting money out of those bonds and just plowing back into the treasury yield. Okay, so where's the okay? The staff continued to judge that the risk to the baseline projection for economical activities was skewed to the downside, and the risk around the inflation projection was skewed to the upside. Basically, this was what I talked about yesterday in my Instagram as well. In case if you are not following me on Instagram, it's right here. Okay, just follow me on Instagram so that you can basically see that I actually posted on my story. I'm not sure if you can see it afterwards. But yeah, basically they're talking about a economical activity going to the downside and then the inflation projection going to the upside. Overall, the following 2 years, the boost to the consumer prices caused by supply issues were expected to partly reverse. So basically, when they actually bring up this word partly reverse, the Fed basically never used the word partly reverse before. So we are basically thinking that this is their way of introducing transitory all over again. And energy prices were projected to decline, which it didn't. So quite ridiculous. I'll be doing like a summary of the entire thing at the end. So yeah, participant generally expected global supply chain bottlenecks to persist well into next year at least. So when they say next year at least, basically we are expecting 1 to 2 years because the Feds like to be safe. So when they do say this kind of thing, we are expecting supply chain bottlenecks to at least be here all the way until 2023. That's horrible. Okay, this global supply chain bottlenecks was expected to be a very transitory issue. We expected to get over this by 2022, maximum 2023, like January. But now we are expecting it to go to 2023, even maybe 2024, which is why this is so dangerous at the moment. Over here, many participants noted that the emergence of the Omicron variant made the economic outlook more uncertain. Several remarked that they did not yet see the new variant as fundamentally altering the path of economic recovery in the United States. So basically, this is one of the better points. Okay, so this is what they are trying to say, that okay, Omicron is not as bad as we think. Omicron is definitely way better than Delta. So this is one of the better points. A participant pointed to a number of signs that the US labor market was very tight, including near record rates of quits and job vacancies. So this is also very good. So what they are basically saying here is that, there's not a lot of people quitting their jobs, and the job vacancies is very, very close to zero, which is also one of their contributing points, because in order for them to taper faster, and also in order for them to raise rates right after that, is for them to reach max employment as soon as they can. But the thing is that because they have max employment, but the thing is that the other point, which is the price stability, they do not have the price stability in the market, and because of that, they are unable to just fulfill this entire thing and just say, okay, let's go for the quick taper. Okay, the market is the pre-market is open. I'll look at it later on. But anyway, some participants noted that the trim mean measure of the inflation have reached decade high levels, basically where we are talking about how inflation has never been this high ever since 1980s or something along that line. And the percentage of product categories with substantial price increases continue to climb. So this is when we are talking about your used cars, used trucks, so we're talking about your oil prices, your energy prices, and then continue to anticipate the inflation would decline significantly over the course of 2022 as supply constraint eased. Almost all stated that they had revised up their forecast of inflation for 2022 notably, and many did so for 2023 as well. So this is crazy, which is why I put a GG here, because if this happens, it means that what we actually had for our dot plot and our economical projection before does not mean anything anymore. Because when they say that they are expecting 2022 to be 2.5, which basically I even talk about it in my prediction for 2022 as well, we are not getting 2.5%. Like, without a doubt, we're not getting 2.5%. I said maybe 3.5%, which is also my prediction. I don't think in 2022 we are going to get inflation just disappearing like that. I don't think that's how you work. Okay, over here they say, a particular participant pointed to the rising housing costs and rents. I also talked about this in the last CPI reading as well. The housing costs and rents, more widespread wage growth driven by labor shortages, and more prolonged global supply side friction, which could be exacerbated by the emergence of the Omicron variant. Basically, it's a good thing. Cited business context feeling confident that they would be able to pass on higher cost of labor and materials to their customers. So basically what this means is that, because if I am a business and I'm able to just pass on any increased cost in my labor and my materials, I can just pass it over to my consumers and just be like, okay, because inflation is here, everything's going to be 20% more, everything's going to be like 10% more for the service, 20% more for the materials. Are you okay with it? If you're okay with it, then yes, then go for it. Which is why even when you're going out right now, when you're buying anything, when prices go up, you kind of don't have a chance to be like, are you sure prices is really going up that much? Basically, all the main businesses are just saying that, okay, you know what? Here is why inflation is like screwing us in the back, and we are gonna pass over the cost over to you guys. And a lot of time, the consumers are okay with that, because we are now living in the era where we are starting to accept inflation as a concept of living, basically. So that's pretty bad. Okay, so participants agreed that the committee's criteria of inflation rising to 2% and moderately exceeding 2% for some time has been more than met, which basically, again, they are contributing factor to why they want to taper quicker and also raise rates. All right, so committee judged that its employment and price stability goals were not complementary in the light of the economic developments, and that inflation pressure and inflation expectation were moving materially and persistently higher in a way that could impair the attainment of the committee's longer run goals. So basically, back to the economical projections, when we're talking about 2022 and 2023, basically what they're saying here, that here is now saying that, oh, this is not really what we expected. So there might be some changes in our next economical projections, which is total BS. So we are gonna get destroyed. There's just so many like bearish point in this FOMC meeting that is just ridiculous. So resulting in an end to the net asset purchase in mid-March. So over here, basically what they're saying is that they are going to stop tapering by mid-March. Okay, and there is a very, very good chance mid-March can mean the 14th of March. And then 15th of March is the FOMC meeting, which is why I'm saying we are going to get our rate increase in March, and there's a very, very good chance this happens. This is why I'm 95% sure that we're going to get our rate hikes in March for the FOMC. But yeah, basically the rest is just the normal stuff. So yeah, just to give you guys some sort of like a summary of what is actually being said here. Inflation is going up. Obviously, we all know about it. The bonds with shorter duration are now getting more pressure, which means that people are most likely getting out of the 2-year bonds. They are trying to get over to the 5-year bonds, the 10-year bonds, the 30-year bonds and such. Faster rate hikes, basically, this is what they're hoping to go for. This is what they are likely to go towards to. This is their first card for them to actually play if they can. So a faster rate hike. They say that inflation is to partly reverse. I'm not gonna believe in this lie anymore. Whenever they said anything about transitory, I took your lie the first time. First time, shame on you. No, first time, shame on me. Second time, shame on you. So I'm not taking this anymore, man. Okay. No, wait. First time, shame on you. Second time, shame on me. Yeah, that's it. Yeah. Anyway, interest rates going up better than waiting, and then because the thing is that back in 2017, where we had the same issues as well, where we had interest rates going up, and then basically they said that we're gonna wait a little bit before we actually start tapering again, and because of that, the entire economy kind of collapsed in 2017 over to 2018. You can see the S&P curve. Basically, we had like 17% trending downwards in like a day after the FOMC actually came out. I did some historical research for that, so horrible. Supply chain issues lasting years. This is very, very important. If it's going to be lasting for years, this is possibly going to be one of the worst case scenario that we can see in a high inflation economy. And then financial stability risk going up, inflation risk going up, economical activity going down. Business are confident to pass over the cost of labor and material over to the consumer, like I said before. Rate hikes to be bumped up, which is basically what they're saying is that because usually for rate hikes, we are talking about a 0.25% every single time we have a bump up. I feel that because of this kind of FOMC report, there is a huge chance that they might be saying that, we can handle we can handle 0.3% actually. Like we can do 0.3, we can do 0.35. And if that actually happened, then horrible. Again, now, psychological inflation fears makes more inflation. So basically, for example, if right now I am a business that deals with aluminum. Basically, I buy aluminum, I do something with the aluminum, and I sell the aluminum, for example. So because of this whole psychological inflation, what this means is that if I feel that the prices of aluminum is going to go up, today I am going to buy 3 years worth of aluminum, and I'm just gonna rent a storehouse and just store all this aluminum, and I'll see when I actually need them, and then I'll use it as it is. And because of what I'm doing right now, because I am going to be doing my purchase for the next 2 years, basically the aluminum market is going to be like, all right, person A won 3 years worth of aluminum. So now I might not I as the aluminum supplier might not have enough aluminum for me to actually sell to all my businesses, all my business partners. And because of that, there would be a supply chain shortage on aluminum. And when the aluminum supplier eventually do get more aluminum, then he will just be like, okay, you know what? Instead of me selling at, I don't know, like $100 per gram, I don't know. Oh, okay, like, per gram, that's more than gold. Okay, like maybe like $1 per gram. I'm gonna be selling it at $1.30 per gram. So that's gonna be a 30% increase. And you will see who wants to buy it from there on out, that kind of thing. And because of that, that kind of causes more inflation. It's kind of like a inflation domino effect, which is why for psychological inflation is also one of the fear factors that actually cause more inflation over the long term. Yield curve inversion, increased risk on financial stability, because basically when the yield curve go down, people are basically plowing money into the bonds market instead of staying in the stocks market. And because of that, the stocks market will not have enough funds, and eventually will have a financial stability risk, aka a recession. Risk to increase, rents to increase in price, but it's not being reflected on the CPI. I think this was a concern that I actually brought up before. But since I'm not American, I don't really care either. But and then lastly, basically the best thing, the only positive out of this entire thing, which is Omicron is not a big concern. So yeah, basically this is the entire report. I took about like an hour or so for me to finish reading the entire thing and do all the notes taking for this entire report. But yeah, this is going to be the only news for today, because I'm pretty sure that every single news outlet is going to just be talking about this. Like, just look at this, okay? Wall Street Journal, they're going to be talking about the Fed's minute, okay? We go to Barron's, okay? I'm just going to refresh Barron's. I can almost, Fed signal rate hikes are coming earlier and faster, okay? Bloomberg, okay? Fed's leave gradualism earlier, the notes that I actually showed you guys. And let's look at the CNBC, okay? CNBC. Okay, CNBC is the only oddball. They have it on the 5th place. Apparently, they think that Harvard-trained economists own your home is more important. But I don't know, man. But yeah, basically, the entire market feel that this is the most important news. So we are going to be seeing some down market movement, which is why I'm very, very happy that I actually bought a few puts on Tuesday when I saw that the Feds are actually taking away the market shares from the open market. So I thought that that would be a good time for me to actually get in some puts. I bought more Ford puts, I bought Rivian puts, I bought Apple puts. But yeah, I think it's gonna be interesting for us to really see how this actually plays out in the next 3 to 5 months period. I'm not sure what will actually happen, but I think this is gonna be quite interesting for us to really see what will happen when the rate hikes eventually happen. But anyway, that's all I have for today, and I'll see you guys tomorrow. Bye.